Nobody seems to know about this Federal Reserve secret. Nobody has noticed the biggest force behind stock prices, the one that influences them just like gravity influences the physical world. Well, in this video, I'm going to tell you something you won't find in any book. It's nowhere else, except for one tiny, overlooked study or paper. And it basically reveals that the real power behind stock prices, just like the prices of goods, lies in the hands of the US Central Bank, the almighty Fed. And it also gives you a magical indicator to tell whether the US stocks will fall or rise. So, the Fed was born in secrecy, literally. In 1910, a group of the most powerful bankers in America slipped away to Jekyll Island under the cover of darkness to draft the blueprint for what would become the Federal Reserve. This meeting wasn't just about creating a central bank. It was about consolidating control over the lifeblood of the economy, money itself. Today, that same institution remains a mysterious hybrid, where private banks own shares, yet it wields public authority, controlling literally trillions in assets. The Federal Reserve doesn't just react to the economy, it engineers it. Let's unravel the layers and dive deeper into what is the greatest power this institution has. This 1982 study, titled The Mysteries of the Federal Reserve System, offers a deep look into the workings of the Fed. When you go grocery shopping, the amount you can buy is limited by two factors: the prices of the goods and the size of your budget. This is what we call purchasing power, the real value of your money in terms of what it can buy. For example, if prices rise but your income stays the same, your purchasing power decreases. It's a simple yet critical concept that affects every financial decision, from daily necessities to long-term investments. Now, here's where it gets fascinating. There's a theory called the quantity theory of money, which posits a direct relationship between the money supply and price levels. Essentially, it argues that if the supply of money in the economy, measured by something like the M2 money aggregate, which includes cash in circulation, checking deposits, savings deposits, money market funds, and other near-money assets. When M2 increases, prices of goods and services will rise proportionally over time. This theory suggests that expanding the money supply without corresponding growth in goods and services can lead to inflation, eroding the purchasing power of every dollar in your wallet. It's a simple formula, with profound implications for the economy and your everyday life. And here it is, the biggest secret hiding in plain sight, yet overlooked by economists, investors, and authors alike. What if I told you that the trajectory of stock prices isn't just about earnings, market sentiment, or economic fundamentals? No, there's something far more powerful at play, something that operates quietly in the background yet controls everything like an invisible hand. The answer is the money supply, specifically measures like M2, which represent the total liquidity in the economy. Take a look at the chart. The S&P 500, a proxy for the stock market, moves almost in lockstep with the growth of the M2 money aggregate. Coincidence? Hardly. This alignment is rooted in the principles of the quantity theory of money. But here's the twist no one talks about. Its application extends beyond goods and services to financial assets. When the central bank expands the money supply, whether through interest rate cuts, bond purchases, or outright money printing, it injects liquidity into the economy. That liquidity doesn't just sit idle. It flows into the stock market, driving prices higher as investors chase returns on their excess cash. It's not a theory you'll find in textbooks, but the evidence is obviously undeniable. The more money in circulation, the more fuel for stock prices to rise. This relationship reveals a profound truth. From the 1980s through the early 1990s, the S&P 500 generally stayed aligned or slightly ahead of the M2 curve. During the early 1980s recession caused by Volcker's interest rate hikes, the S&P 500 flattened, but as inflation was brought under control, it surged in the late 1980s. The 1987 crash briefly disrupted this balance, but monetary easing helped the market recover quickly. The late 1990s saw the S&P 500 skyrocket above the M2 during the dot-com bubble, driven by speculative euphoria. When the bubble burst in 2000, the S&P 500 fell sharply below the M2 curve as liquidity grew while confidence evaporated. A similar pattern emerged during the 2008 financial crisis, where excessive pre-crisis market growth gave way to a collapse, leaving the S&P 500 below the M2 as the Fed flooded the system with liquidity. From 2010 onward, the S&P 500 climbed steadily above the M2 during a long bull market fueled by monetary easing and low rates. In 2020, COVID-19 caused a sharp drop in the S&P 500 below the M2 as panic set in, but massive liquidity injections and rapid market recovery restored the balance. This pattern highlights the recurring role of liquidity in market downturns and recoveries. This theory isn't widely known because it sits in a no-man's land between two worlds that rarely talk to each other: macroeconomics and investment management. Economists, sitting in their ivory towers, are laser-focused on GDP growth, inflation rates, and theoretical models like supply and demand. They write dense papers and teach that stock prices are driven by fundamentals: earnings, dividends, and market expectations. Meanwhile, investment managers live in a completely different universe, one obsessed with charts, technical indicators, and portfolio allocation strategies. They operate in the now, while economists analyze the broad strokes of tomorrow. The result? A glaring blind spot. This idea, the direct link between money supply and stock prices, requires a fluency in both macroeconomic policy and market behavior, and very few people dare to cross that intellectual divide. Thank you so much for watching. If you liked this video, don't forget to give it a like, thumbs up, or subscribe. It's so appreciated. Have a great day.